Hey everyone, today we're talking about how to find good companies to invest in 10 minutes or less. One of the top things to check is the company's earnings reports of the last 3 to 5 years. When you check these reports, you're asking yourself, are their earnings steadily increasing year after year? To check this, you will need to review the annual or quarterly earnings reports. All publicly traded companies have to have their earnings available for the public to view. Now, some platforms used for day trading and quickly moving money in from one company to another often supply earning and other various data within their own software. This type of software is usually for the more experienced trader and often has a monthly fee attached to it. A quick search on something more common like Wealthsimple shows that they do not list earning reports on their website. So this means you must go to the government website to find the reports. Start by going to sec.gov, hover over the Filings tab and go down to Company Filings. In the search box, type in the name or ticker of the company you want to search, such as Tesla. Then click on View Filings and check the earnings from the last 3 to 5 years. You want to see a steady increase in earnings each year. The more predictable they are, the safer bet you're going to make money. Earnings reports that are up and down, or worse, on a steady decline is an immediate red flag to avoid that stock. Don't get stuck on a stock just because you like it. You need to be objective and let the numbers decide for you. So you check the earnings and you see consistent growth and think, perfect, I'll put $10,000 in. Wrong. Don't do this. We need to check the company's strength relative to its peers and industry. So how do we do this? We check the price to earnings ratio, also known as the PE ratio. The PE ratio is used to determine how much investors are willing to pay for a stock relative to the company's earnings. To get this PE ratio, you take the current price of a stock and divide it by the company's earnings per share. Or you can find it on investment websites like Simply Wall Street. Simply put, if you take a group of companies all around the same price range and the same sector and view the PE ratio, the company with the lowest PE ratio would typically be the best bang for your buck. There are many other factors that investors look at, but this is the main one. Lastly, you want to make sure the company has a high volume of shares traded each day. You don't want a company that doesn't show much in volume, as it may be harder to buy and sell your shares. Next is the debt to equity ratio. The debt to equity ratio is the proportion of shareholders' equity and the debt used to finance company assets. Closely related to leveraging, the ratio is known as risk, gear, or leverage. The golden rule here is the debt to equity ratio should be less than 2. And a simple check of industry norms on readyratios.com that it is very uncommon for industries to surpass a ratio of 2.0. But if your industry was, say, the health sector, the highest the industry has been in the last 5 years is 0.70. If the company you were looking at had a debt to equity ratio of 1.5 or higher, then you could say it is not in line with the industry average, and you may be better moving on to a different company. Again, don't get married to a company. There are thousands of companies to pick from, and if something does not fall in line, then make a note and keep looking. Next are dividends. And what the heck are dividends anyways? Well, when you put your money into a stock, the company then in turn uses your capital. It allows them to buy things, loan, and finance assets. A dividend is a company's way of saying thanks for letting them use your money. Dividends is something that the company will pay out quarterly and annually. So why are dividends important on telling us if a company is good to invest in or not? Well, firstly, not all companies pay dividends. Usually larger companies like Disney will pay dividends. And when they do, they'll send you a check in the mail every quarter. Often they'll be anywhere from 20 cents to a few dollars for every share you own in that company. Just like the earnings reports, we want to check the dividends. Are they gradually increasing each year or every few years? Do they stay the same? Typically, the dividends gradually increase at a moderate rate would be the most predictable and the safest indication for healthy growth in a company. Last but not least, we're going to talk about leadership and management. This is going to be a key factor in the stability and growth of any company. When you're looking into companies, if you don't realize it by now, you're looking for steady, predictable growth. That means steady, predictable growth for your money. We're not looking at get rich quick. We're looking to increase our savings each year while mitigating risk. Leadership is no different. Who are the principals, CEO, and top managers of the company? Do they fall in line with steady growth? Or has there been newly appointed CEO every year after year for the last 3 years? Does the company promote growth within, or do they hire from the outside? In my experience, companies that bring in big name CEOs from outside of the company to try and make a big splash in corporate earnings, but in reality end up doing the opposite. It usually takes a good CEO a few years to get their feet under them. When looking to leadership, look for long-time employees that have grown with the company and promoted within. These are the traits of healthy leadership. If you go to the leadership portion and it all checked out, then congratulations. You've taken the time to do the research and find a company that is very likely a healthy investment. There are many more steps you can take, but these are my top ones. Thanks for watching. Please give this video a like, subscribe to my channel, and let us know what you'd like to hear in the next 10 minutes or less.